Today, our lecture will focus on a critical facet of auditing, reports on audited financial statements. We will delve into the reporting principles that guide auditors in communicating their findings on the financial statements of an entity. Audit reports not only validate the accuracy of financial information, but also must effectively communicate the results of the audit to the various stakeholders. The reporting principles under generally accepted auditing standards provide the framework within which auditors operate, ensuring a standardized approach to the reporting process. The audit report should be clear in its language and transparent in its presentation of the auditor's opinion. It should leave no room for ambiguity, enabling users to make informed decisions based on a thorough understanding of the auditor's findings. We will discuss the specifics of the audit report components as outlined by the auditing standards. Understanding the nuances of these components is crucial for communicating the audit opinion on audited financial statements. The key differences between audit reports for issuers, those companies whose securities are registered with the Securities and Exchange Commission, and non-issuers, private companies, primarily stem from additional regulatory requirements and scrutiny imposed on public companies. For example, public companies, their audit reports are subject to more stringent regulatory oversight, primarily governed by the Public Company Accounting Oversight Board, known as the PCAOB. The PCAOB sets specific standards for the audit of public companies to enhance the reliability and credibility of financial statements, whereas non-issuers, their audit reports adhere to generally accepted auditing standards, also referred to as GAAP, established by the Auditing Standards Board of the American Institute of Certified Public Accountants. While private companies may be subject to some regulations, the level of scrutiny is generally less rigorous than that for public companies. The auditor's report for public companies typically includes additional sections, such as the report on internal control over financial reporting, where auditors express an opinion on the effectiveness of the company's internal controls. This is required under the Sarbanes-Oxley Act. Private companies are typically not required to have their auditors opine on internal controls unless the company is subject to a specific regulatory or contractual requirements. Public company audit reports include additional disclosures, such as critical audit matters, which represent a key aspect of the auditor's report, which was introduced by the Public Company Accounting Oversight Board. CAMs are specific matters that are communicated or required to be communicated to the audit committee and are related to accounts or disclosures that are material to the financial statements and involve especially challenging, subjective, or complex judgment. Auditors can issue different types of opinions on audited financial statements based on their assessment of the financial information's conformity with accounting standards and the overall fairness of presentation. The unmodified opinion, also known as the unqualified opinion, is the most favorable and common type of opinion. It indicates that the financial statements are presented fairly in all material respects, in conformity with the applicable accounting standards or framework. A qualified opinion is issued when the auditor concludes that there is a limitation on the scope of the audit or a departure from generally accepted accounting principles, GAAP, that is not pervasive. It suggests that except for the specific issues identified, the financial statements are fairly presented. An adverse opinion is the most severe form of qualification. It is issued when the auditor determines that the financial statements do not present fairly in all material respects, the financial position, results of operations, or cash flows in accordance with the applicable accounting standards. A disclaimer of opinion is issued when the auditor is unable to form an opinion on the financial statements due to significant uncertainties or limitations in the audit scope. It is crucial for auditors to clearly communicate their findings through these opinions, providing stakeholders with insights into the reliability and conformity of the financial statements. The choice of opinion depends on the auditor's assessment of the evidence gathered during the audit process. An unmodified audit opinion is composed of several key components. The ASB aimed to enhance the transparency and relevance of the auditor's report for non-issuers. The main elements of the unmodified audit opinion include the opinion on the financial statements. The opinion section explicitly states the auditor's opinion on the financial statements. In an unmodified opinion, this section will express that the financial statements present fairly in all material respects in accordance with the applicable financial reporting framework. In the basis for opinion section, the section discusses the auditor's basis for forming the opinion. It includes reference to the auditor's evaluation of audit evidence, the assessment of accounting principles used, and any significant audit matters. In the management responsibility for the financial statements, the section outlines the responsibility of management for the preparation and fair presentation of the financial statements in accordance with the applicable financial reporting framework. The auditor's responsibility section emphasizes that the audit is conducted in accordance with generally accepted auditing standards and includes a statement about obtaining reasonable assurance that the financial statements are free from material misstatements, whether due to fraud or error. It is important to note that the specific wording and format of the auditor's report may vary, but these key components reflect the structure required by Statement on Auditing Standards number 134 for an unmodified audit opinion for non-issuers. Departures from an unmodified audit opinion occur when the auditor encounters issues during the audit that affects their ability to express an unmodified opinion on the financial statements. There are two types of modified audit opinions that can result from such departures: a qualified opinion and a disclaimer of opinion due to a scope limitation. A qualified opinion is issued by the auditors when they encounter specific issues during the audit that affect certain aspects of the financial statements, but not to the extent that it requires an adverse opinion or disclaimer of opinion. In other words, the financial statements are generally fairly presented, but there are certain exceptions or limitations that the auditor needs to bring to the attention of the users. Auditors first consider whether the identified issue is material in the context of the financial statements as a whole. If they determine that the issue is indeed material, the auditor will consider the pervasiveness of the issue. If the issue is pervasive, affecting a large portion of the financial statements, auditors are inclined to issue an adverse opinion. If the issue is isolated or confined to a specific account or disclosure, a qualified opinion will be more appropriate. Let's consider an example. Imagine a retail company that has been engaged in a lawsuit with a major supplier. The outcome of the lawsuit is uncertain, and it involves a substantial amount of money. The company, however, has not disclosed the lawsuit in its financial statements, and the potential loss is material. The auditor does not believe that the issue is pervasive to the financial statements as a whole. In this scenario, the auditor would issue a qualified opinion expressing that, except for the lack of disclosure regarding the lawsuit and the uncertainty surrounding the potential loss, the financial statements are fairly presented. The specific wording of the opinion would detail the nature of the departure from the unmodified opinion and provide transparency about the issues identified during the audit. When an auditor issues a qualified opinion, the auditor report undergoes modifications compared to the standard unmodified opinion. In the qualified opinion, the opinion section explicitly states that the financial statements present fairly except for the effects of the matter described in the basis for qualified opinion paragraph. In that section, the basis for a qualified opinion is introduced. This section provides details about the specific issues or reasons that led to the qualification. The management responsibility and auditor responsibility for financial statements remain unmodified. When the auditor determines that the issue is material and pervasive, the auditor will issue an adverse opinion. The opinion paragraph changes significantly. Instead of expressing that the financial statements present fairly, the adverse opinion explicitly states that the financial statements do not present fairly. The basis for opinion section will provide details about the specific issues or reasons that led to the adverse opinion. Management's responsibility for the financial statements section and the auditor's responsibility section remains unmodified. A scope limitation occurs when auditors are unable to obtain sufficient appropriate audit evidence to form an opinion on the financial statements. This limitation may arise due to restrictions imposed by the client or circumstances beyond the client's control or the auditor's control. A scope limitation can have a significant impact on the audit and may result in a qualified opinion or, in severe cases, a disclaimer of opinion. An example of a client-imposed scope limitation is where the client may restrict the auditor's access to certain information, documents, or personnel, preventing the auditor from obtaining complete and relevant evidence. For example, management might refuse to provide access to critical contracts or internal records. Circumstance-imposed scope limitations arise through no fault or control of the client or the auditor. For example, natural disasters such as earthquakes, floods, or fires can disrupt operations and make it difficult for the auditor to physically assess the client's premises or obtain necessary documentation. Unforeseen global events, such as pandemics, can lead to restrictions on travel, lockdowns, and disruptions to normal business operations. These circumstances can impede the auditor's ability to perform on-site procedures or access physical records. A scope limitation can have a significant impact on the audit and may result in a qualified opinion or, in severe cases, a disclaimer of opinion. When auditors encounter a scope limitation, the process of determining the type of report to issue involves careful evaluation of the limitation's nature, extent, and impact on the audit. The decision is guided by auditing standards, professional judgment, and the specific circumstances surrounding the limitation. Based on the assessment of materiality, pervasiveness, client responsibility, and client cooperation, auditors determine the appropriate type of opinion to issue. The options include an unmodified opinion. If the limitation is not material or pervasive and the client is cooperative, the auditor can issue an unmodified opinion. For example, a manufacturing company experiences a temporary disruption in its supply chain due to a brief labor strike at one of its major suppliers. This disruption affects the timely delivery of certain raw materials needed for production. The auditor is unable to obtain the usual confirmation of the inventory levels of these specific raw materials directly from the supplier due to the strike. Recognizing the circumstance-imposed limitation, the auditor assesses the situation and determines that the affected raw materials represent a small portion of the overall inventory and are not material to the financial statements. The disruption is temporary, and the company has communicated alternative plans to address the issue and resume normal operations. If alternative procedures are successful in providing the necessary audit evidence to address this scope limitation, an unmodified opinion may still be appropriate. For example, the client has implemented a new accounting software system during the audit period, and due to technical issues, the auditor encounters difficulties assessing and verifying certain transactional data within the system. The client is unable to provide the required access or export the data in usable form. In response to the scope limitation, the auditor decides to perform alternative procedures to obtain assurance on the affected transactions. The auditor decides to perform extensive substantive analytical procedures, compare the data from the new system with data from the previous system, and gather additional third-party confirmations from relevant vendors and customers. After performing the alternative procedures, the auditor determines that the financial statements are not materially misstated and the impact of the scope limitation is mitigated. In this case, the auditor issues an unmodified opinion on the financial statements, indicating that in their opinion, the financial statements present fairly in all material respects in accordance with the applicable financial reporting framework. If the limitation is material but not pervasive, the auditor may issue a qualified opinion explicitly stating the nature and effects of the limitation. For example, a regional airline company experiences a significant disruption in its operations due to a sudden grounding of its entire fleet following a safety directive issued by the aviation authorities. The grounding occurs during the peak travel season, impacting the company's financial performance and causing a delay in the completion of the audit. Due to the grounding of the airline's fleet, the auditor faces challenges in obtaining sufficient audit evidence, and they are unable to perform alternative procedures. After careful consideration, the auditor concludes that the limitation is material to the financial statements but not pervasive. In the auditor's report, the auditor will explicitly disclose the circumstance imposed limitation resulting from the disruption in the airline's operations and the inability to obtain complete and timely audit evidence. As a result, the auditor issues a qualified opinion stating that except for the effects of the limitation on the audit scope, the financial statements present fairly in all material respects in accordance with the applicable financial reporting framework. If the limitation is pervasive, preventing the auditor from forming an opinion on the financial statements, the auditor will issue a disclaimer of opinion. For example, a multinational construction company is involved in a legal dispute with a government entity over a major infrastructure project. Due to the ongoing legal proceedings, the company is unable to provide the auditor with key documentation related to the project's revenue recognition and contractual obligations. The legal dispute prevents the auditor from assessing critical information necessary to assess the company's revenue recognition policies and obligations under the construction contracts. The company explains that legal restrictions prohibit the disclosure of certain documents related to the ongoing litigation, making it impossible for the auditor to obtain sufficient and appropriate audit evidence. In the auditor's report, the auditor explicitly discloses the circumstance-imposed limitation resulting from the legal dispute and the lack of access to essential documentation. After evaluating the significance of the missing information and the potential impact on the financial statements, the auditor concludes that the limitation is pervasive and prevents them from forming an opinion on the financial statements. Consequently, the auditor issues a disclaimer of opinion explicitly stating that they do not express an opinion on the financial statements. When the auditor issues a disclaimer of opinion, in place of the standard opinion paragraph, a disclaimer of opinion paragraph is inserted. This paragraph explicitly states that the auditor does not express an opinion on the financial statements. In the basis for opinion, the auditor provides details about the specific reasons or limitations that led to the disclaimer of opinion. It explains the circumstances that prevented the auditor from forming an opinion. The management responsibility section remains unchanged. However, the auditor's responsibility section is modified to explicitly state that the auditor was unable to obtain sufficient appropriate audit evidence and therefore is unable to express an opinion on the financial statements. In summary, when the auditor encounters issues during the audit that affect their ability to express an unmodified opinion on the financial statements, this results in departures from the unmodified audit opinion. The type of opinion issued is dependent on the nature of the issue, the auditor's assessment of the materiality of the identified issue, and the auditor's evaluation of the pervasiveness of the identified issue. In an audit report, both an emphasis of matter paragraph and an other matters paragraph are used to draw attention to specific information within the financial statements or the audit process. While both types of paragraphs serve to highlight specific information, the key distinction lies in whether the matter is presented in the financial statements, an emphasis of matter paragraph, or if it pertains to other relevant information about the audit process, the other matters paragraph. In both cases, the unmodified opinion remains intact. The auditor is explicitly stating that, in their opinion, the financial statements present fairly in all material respects in accordance with the applicable financial reporting framework. The inclusion of emphasis of matter or other matters paragraphs is a way for the auditor to enhance the transparency and context provided to users without altering the fundamental conclusion about the financial statements. The emphasis of matter paragraph may relate to accounting principles such as consistency in accounting principles, uncertainties such as going concern, or other significant aspects of the financial statements. Changes in consistency refer to changes in accounting principles or reporting entities that materially affect the comparability of financial statements from one period to another. When such changes occur and are properly accounted for and disclosed in accordance with accounting standards, auditors may include an emphasis of matter paragraph in their audit report to draw attention to these changes. For example, a change in accounting principle would result from a company switching from using the FIFO method to the weighted average cost method for valuing its inventory. A change in reporting entity is another example, where a company might acquire a significant subsidiary that results in a change in the reporting entity impacting the comparability of financial statements. In each example, the emphasis of matter paragraph serves to highlight the changes in consistency and provides additional context to users of the financial statements. This helps users understand the nature of the change and the reasons behind them, ensuring transparency and clarity in financial reporting. Importantly, the inclusion of the emphasis of matter paragraph does not alter the unmodified opinion on the financial statements, as the auditor is expressing that, in their opinion, the financial statements present fairly despite the changes in consistency. Uncertainties in financial statements arise when certain events or conditions create significant doubt about the entity's ability to continue as a going concern, or when there are substantial uncertainties that may impact the financial statements. When auditors encounter such uncertainties that are appropriately disclosed in the financial statements, they may include an emphasis of matter paragraph in their audit report to draw attention to these significant issues. The going concern uncertainty is one that arises when there are significant doubts about an entity's ability to continue its operations and meet its obligations for the foreseeable future. The assessment of going concern is a critical aspect of the auditor's responsibilities, and auditors are required to consider various factors and management's plan to address any identified uncertainties. In most cases, the auditor will include an emphasis of matter paragraph in the audit report to draw attention to the going concern uncertainty. This is done to provide transparency to users of the financial statements and to ensure they are aware of the issues and management's plans. However, there are circumstances in which a going concern uncertainty may be so severe and pervasive that it leads the auditor to issue a disclaimer of opinion. This means the auditor is unable to express an opinion on the financial statements because the uncertainties are so significant that they cannot form a basis for providing reasonable assurance. This is a serious matter and indicates a lack of confidence in the entity's ability to address its financial challenges. Disclaimers of opinion are relatively rare and are reserved for situations where the going concern issues are so severe that they prevent the auditor from providing reasonable assurance about the financial statements. For public companies, the Sarbanes-Oxley Act requires auditors to issue a separate report on the effectiveness of the company's internal control over financial reporting. Their responsibilities include evaluating the effectiveness of the company's internal control over financial reporting, which involves testing and assessing the design and operating effectiveness of controls relevant to the preparation and fair presentation of financial statements. Based on their assessment, the auditor is required to express an opinion on the effectiveness of internal controls over financial reporting. Auditors may issue a separate report or an integrated report. An integrated report combines the auditor's opinion on the financial statements and the opinion on internal control over financial reporting into a single document. Both opinions are presented together. A separate report involves issuing two distinct documents. One is the report on the financial statements, including the opinion on the financial statements, and the other is the report on internal control over financial reporting, which includes the opinion on the effectiveness of internal controls. Ultimately, the choice between an integrated report and a separate report depends on regulatory requirements, company preferences, and the desire for a streamlined or more detailed presentation of audit opinions. An unqualified opinion on internal control over financial reporting indicates that the auditor has found the company's internal controls to be effective in providing reasonable assurance regarding the reliability of financial reporting. The auditor, for example, tests various controls related to financial reporting processes and concludes that they are suitably designed and operating effectively. There are no identified material weaknesses, and the company's internal control environment is considered robust. A disclaimer of opinion on internal controls over financial reporting is issued when the auditor is unable to express an opinion due to significant limitations or restrictions in the scope of the audit, preventing them from obtaining sufficient and appropriate audit evidence. For example, the company's management imposes severe restrictions on the auditor's ability to assess critical information or documentation necessary to evaluate the effectiveness of internal controls. The limitations are so pervasive that the auditor cannot form an opinion on the overall effectiveness of internal controls over financial reporting. An adverse opinion on internal controls over financial reporting is issued when an auditor determines that one or more material weaknesses exist in the company's internal control system, which increases the risk of material misstatements in the financial statements. For example, the auditor identifies significant deficiencies or a combination of deficiencies in internal controls that, when considered together, create a reasonable possibility of material misstatement. For instance, there may be inadequate segregation of duties, lack of oversight, or insufficient controls over the financial reporting process. It's important to note that these opinions are specific to the effectiveness of internal control over financial reporting and are separate from the audit opinion on the financial statements. The auditor may issue an unqualified opinion on the financial statements, even if there is a qualified adverse or disclaimer of opinion on internal controls over financial reporting. For example, an adverse opinion on the internal controls over financial reporting indicates that the auditor has identified one or more material weaknesses in the company's internal control system. Material weaknesses in internal control increase the risk of material misstatements in the financial statements. However, the adverse opinion specifically relates to the effectiveness of internal controls, not the accuracy or fairness of the financial statements themselves. Management may be able to assert that despite the identified material weakness in internal control, they have implemented compensating controls or additional procedures to address the potential misstatements. If these measures are deemed effective, the financial statements may still be considered reliable. The auditors may be able to perform additional substantive procedures even if there are material weaknesses in internal control. These procedures involve directly testing account balances, transactions, and disclosures to ensure their accuracy and completeness. If the auditor can obtain sufficient appropriate audit evidence through these substantive procedures, it may support an unmodified opinion on the financial statements. It's important to note that the presence of material weaknesses in internal control is a serious matter that requires attention and remediation. However, it doesn't automatically mean that the financial statements are materially misstated. The auditor's responsibility is to evaluate the impact of internal control deficiencies on the financial statements and express opinions separately on both aspects.